one of the first question we asked where the oil prices will be at the end of this year. We had 88% who said oil prices will be below $80 a barrel at the end of this year. We asked where oil prices will be at the end of next year. And similar range bound, 70% said that oil prices will remain in the $60 to $80 a barrel range at the end of next year.
I want to get some perspective on what your call is for RWE, but I also want to tie it into a conversation that's kind of unfolding in real time over here in the US, and that is the restart of nuclear power plants that have been mothballed to power AI data centers.
Looking at RWE, they shuttered, or they closed out their nuclear capacity in 2023, although they do report a nominal megawatt basis in their fact sheets still. So that means there's some reserve capacity. There's a couple hundred megawatt hours of capacity of nuclear there still. So I cannot confirm if it would be possible for a company in Germany to sort of reignite or restart nuclear operations to connect something like a data center. That's it. I think perhaps it's like the epicenter of these of AI spending is the US. So I think you're more prone to see these types of projects in the US, given that there's where most of the movement, more of the activities happening in terms of AI.
So we took a look at the European Renewable Developers, which is a group that includes Ørsted, EDPR, Acciona. Funny enough, it doesn't include RWE because, as Patricio said, they're not a pure player renewable. But this is a group that has faced, has clearly underperformed the market since 2021. Their combined market cap is about 50% below what it was at the start of 2021.
Even for this year, there just seems to be such a big difference in expectations of oil demand growth, where IEA expects the oil demand growth this year to be just below 1 million barrels per day. And OPEC still expects it to be about double that amount. And I mean, mind you, it's almost the fourth quarter. We're almost through the year, and there just still seems to be this disagreement. But it looks like, and I think we've seen this in the price reaction, it looks like the actual oil demand growth number will probably be closer to the IEA number, at least for this year, than OPEC's number. And
good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's VI Energy Exchange. Apologize for kicking off a few minutes late. I had to get through airport security. I'm headed up to New York for Climate Week, and it was a bit busier than I anticipated. On the call today, we've got some of the regulars that I think you know, starting over in Dubai. We've got Salih Yilmaz joining from his usual perch, swinging over to Madrid. We've got Patricio Alvarez joining, and last but not least, we've got Joao Martins joining from our European headquarters in London. So let's start today with our very interesting new survey, where we came to a lot of you and asked you what you thought was likely to unfold in energy markets over the next few months and years. And Salih, you've got the first note out detailing some of those results. So why don't you share with everyone what the survey is telling us at the moment?
Sounds good. Thank you, Rob. And as you said, thank you to everyone who's taken part in the survey. We really appreciate it. We had 176 respondents this time. It was the highest that we ever had on these surveys. And as you probably already know, we run these surveys at least once a year, usually twice a year. And a lot of the questions we ask every time. So it's always interesting to see how the answers change over time as well. We asked quite a lot of questions this time, so we're not trying to put all of them in a single note, in a single report, not yet anyway. So we'll be publishing these in batches. But I want to share with you the first one that we published this morning. I think some of the more interesting, perhaps, questions in the survey, and some of them were about oil prices. So one of the first question we asked where the oil prices will be at the end of this year. We had 88% who said oil prices will be below $80 a barrel at the end of this year. We asked where oil prices will be at the end of next year. And similar range bound, I mean, 70% said that oil prices will remain in the $60 to $80 a barrel range at the end of next year. Our third question was on geopolitical risk premium. This was a particularly interesting one for me. And we've been talking about how perhaps geopolitical risk premium attached to prices hasn't really been as much as one might have expected, perhaps 5 years or 10 years ago, given everything that's going on in the Middle East between Russia and Ukraine and Libya. But 94% of the respondents said that geopolitical risk premium currently on prices is less than $5 a barrel, and 70% said it's actually less than $2 a barrel. So, and then finally, we had two questions on the big drivers of oil prices. The first one was what the biggest driver of oil prices is at the moment, and a big majority, 72% actually said it's the China demand and the general macro concerns. And it was actually surprising how few said that it's actually OPEC plus policy or the supply growth in non-OPEC plus or the geopolitical developments. And the final question on this part of the survey was what the drivers will be in the next 2 years. And there's a little bit less certainty in answers with that. 30% said it will be the OPEC plus policy that drives prices in the next 2 years. 30% said, I mean, less than it was in for at the moment question, but 30% said it's going to be the China demand story. And then 26% said that it's going to be the non-OPEC plus supply growth. So that's the one that we published on. We'll continue to publish in the next few days and early next week about the results from the rest of the survey. But this is the first one. If you haven't seen it on the terminal, you can find it there and expect more from us on the answers for the oil demand questions, on the OPEC plus questions, etc. in the next few days and next week.
Okay, thank you, Salih. Patricio, let's swing around to you. Salih just talked about some of the geopolitical risk elements in oil. How's gas faring at the moment? Is geopolitics a factor, weather a factor? Where do things look for the European gas market here at the moment?
Sure. So European gas prices are roughly at 37 euros per megawatt hour at the moment. So that's roughly 5 to 7% up since last week. And that's mainly on expectations for lower than average temperatures through the start of October. At least that's what our fair value model seems to imply. We ran the model recently, and it was telling us that the fair value lies somewhere around 36 and 38 euros per megawatt hour. And that said, looking into what the geopolitics or that side of things, at the impact of potential supply cuts or reductions, we looked at what would happen to the price if Russian flows via Ukraine were shut off, which is what I think the market expects will happen at the end of this year, given that the transit agreement with Gazprom expires by the end of the year. Our model tells us that gas prices could go up to 40 to 42 euros per megawatt hour throughout the winter. But I think it's important to note that sort of the big elephant in the room is always weather. Really, I think that's really the main driver for this winter. Our analysis suggests that we may exit the next winter, like next March, at 40%, roughly 40% full, which is 15% lower than we did last March. And that's just assuming normal weather. So if we had a colder spell of weather, storage again could be a bit over depleted by the end of March. But the other thing that is important to take into consideration is that gas demand has been declining throughout the whole, or let's say throughout year to date. It's declined by 3 to 4%. But the fact that we've decommissioned several coal units in Europe since the beginning of the year. Sorry. The expectation is that all of that will be offset, let's say, with flexible gas generation, which again leaves it up to mostly to weather, with somewhat of a nominal geopolitical risk premium of 2 to 3 euros.
Joao, I want to bring you into the conversation. I know you spent some time also thinking about the gas outlook, particularly kind of in that longer time horizon, when we think about kind of 2030 and beyond. And given that it's Climate Week, I kind of want to get your sense of how things like hydrogen and other alternatives could play a role. Patricio just mentioned coal. Kind of how do you see the long-term evolution over there?
Yeah, sure. Thanks, Rob. So I think if in the short term, the story is very much about, pardon me, very much about how much can demand rebound, and are there any signs of that happening already? Is that protracted or not? And how much supply how flexible is supply to meet that? In the long term, things are much more uncertain. And I mean, for reference, for example, Bloomberg NEF forecasts that by 2030, gas demand will be between 6 and 20% lower versus 2023, which is already a significantly smaller basis than what Europe was used to. And most forecasts do point to some downside to gas demand to 2030 and then potentially stabilizing thereafter. That is not to say that gas will not keep an important role in the energy mix. As Patricio said, we're in Europe phasing out a lot of the coal-fired plants. And although we're trying to decarbonize the electricity mix and trying to electrify the economy, gas will still probably play an important role. Now, in any case, that poses a challenge to companies that operate assets linked to gas consumption, because first of all, they might face stranded asset risk, and then second, they have much more limited growth opportunities. And that is something that we see with, for example, the peer group of gas-regulated companies that we cover, which have much lower growth profiles versus their power grid counterparts. And it's a peer group that is trying to find alternatives for their earnings profile. Some of them can go towards energy efficiency. That's something that is already a bit more tangible. And then, like you mentioned, hydrogen is a longer term alternative. Still on hydrogen, things are very nascent. The outlook is also very unclear. There is no regulatory framework, no clear regulatory framework in Europe for both production and transport. And even the demand picture is not very clear, because hydrogen remains at least 3 times more expensive to use versus gas. And so that poses a challenge for these companies that are also trying to pivot to hydrogen.
Awesome. Thank you, Joao. Patricio, I want to swing back over to you. I want to try and hold 2 ideas in my head here at the moment. One is, you've got a really cool focus idea out on RWE. And for anyone who's on the call, if you don't know our focus ideas, these are sort of our highest conviction, out of consensus calls. So I want to get some perspective on what your call is for RWE. But I also want to tie it into a conversation that's kind of unfolding in real time over here in the US. And that is the restart of nuclear power plants that have been mothballed to power AI data centers. It's a hot topic in energy in the US. I don't think there's the same opportunity in Europe, perhaps with RWE. I don't think the same conditions exist, but maybe you can confirm sort of whether there's this option for nuclear, which I know is very separate from your focus idea, but I know RWE at least used to operate some of the nukes there in Germany, or I believe they did. Over to you, Pat.
Sure. Yeah, you're kind of putting me on the spot there with the second question. But yeah, first focusing, just talking about the focus idea first. RWE is a German power generator, which we think is very interesting. Besides its earnings potential, it's a very interesting company because it has the fastest renewable capacity growth profile amongst peers of its size. So we're talking about faster growth than EDPR, faster growth than Ørsted. It has a great balance sheet. But at the same time, the company is also one of the dirtiest power producers in Europe, given it has the largest lignite fleet in Germany and in Europe. So our focus idea, what we looked into is the fact that perhaps the company was too rash in downgrading its 2024 EBITDA guidance. So they have a 5.2 to 5.8 billion EBITDA range for 2024. And just as power prices plummeted in March down to roughly 60 euros per megawatt hour, that's German baseload, management went out and decided it was time to revise the numbers both for 2024, and also that led to consensus sort of revising 2025 as well. So since then, we've run the numbers with what the baseload power is expected to be in 2025, which has rebounded to roughly 80 to 90 euros per megawatt hour. So that's an important recovery. So we think that both guidance is being too conservative and perhaps consensus is being conservative as well for 2025 numbers. And you have to consider that there's a lot of moving pieces, considering that power prices have continued to decline or have continued, a decline sustained, like in a sustained basis since the energy crisis. So it's really hard to look at all the moving parts. We expect renewables, the renewable segments to perform well, both in the US and Europe, with big catalysts in European offshore in 2027 as well. Now moving on to the other part of the question, which I think it's fascinating, is looking at RWE. They shuttered, or they closed out their nuclear capacity in 2023, although they do report a nominal megawatt basis in their fact sheets still. So that means there's some reserve capacity. There's a couple hundred megawatt hours of capacity of nuclear there still. So I cannot confirm if it would be possible for a company in Germany to sort of reignite or restart nuclear operations to connect something like a data center. That's it. I think perhaps it's like the epicenter of these of AI spending is the US. So I think you're more prone to see these types of projects in the US, given that there's where most of the movement, more of the activities happening in terms of AI. Although we expect those sort of that trend of power demand upside to trickle down into Europe as well, given that Europe is still a data center market that comprises 15 to 20% of the global market. We expect that to trickle down to Europe, but we don't see that momentum or a similar momentum as in the US at the moment.
Okay, thank you, Patricio. For anyone who hasn't seen it, we've mentioned it on this call for every week now. I think we do have a cool deep dive really going in on AI, data center, electricity demand growth. It's a pretty interesting phenomena, and yeah, definitely reach out to us if you want to talk more deeply on that topic specifically. Salih, I want to come over to you and still kind of hit on this idea of energy demand and sustainability kind of nexus, which again, I think is a big theme of some of the discussions happening in New York this week. And I believe that OPEC has a new report out, and they really are doubling down on oil demand growth, at least in their projections. So I want to get you to read the tea leaves for us. What's going on with oil demand? Sort of the behemoth, or one of the behemoths of the traditional fossil fuel side of the business. Where is it headed, and kind of what are the general sort of views in your perspective? Tell us about OPEC, but I'm also curious to know what you think.
Yeah, I think that report from OPEC from yesterday is quite interesting because, I mean, we've talked about this on this call about how, these agencies, OPEC, IEA, they're making these oil demand expectations and estimates for the long term, midterm, and also for the short term for this year. And, we were talking about even for this year, there just seems to be such a big difference in expectations of oil demand growth, where IEA expects the oil demand growth this year to be just below 1 million barrels per day, and OPEC still expects it to be about double that amount. And I mean, mind you, it's almost the fourth quarter. We're almost through the year, and there just still seems to be this disagreement. But it looks like, and I think we've seen this in the price reaction, it looks like the actual oil demand growth number will probably be closer to the IEA number, at least for this year, than OPEC's number. And as this is what the market seems to be looking at, and the market seems to be kind of reckoning, we have OPEC, as you say, kind of doubling down on the longer term demand growth expectations. They're now saying that lower inflation, I mean, inflation under control, and the lower interest rates are going to be even more supportive. The relatively low prices in the recent months are going to be more supportive for demand, and they are doubling down on their demand expectations, and they still think demand will continue to grow all the way into the 2040s. I mean, again, one could argue that both agencies are talking their books a little bit, because now IEA thinks oil demand is peaking in 2029. OPEC is saying it will not peak until 2045, and they're not saying when it will peak. They're just saying that it will continue to grow. I mean, we don't know. A lot of the oil companies that we look at, they're probably thinking the answer is going to be somewhere in between. But importantly, as we always discuss on this call, it is coming, is what probably a lot of the oil companies are thinking. And this is why they are very busy trying to position themselves for the energy transition. And this is why we are seeing in the shift in some of the spending for some of these oil majors, and not only majors, in a lot of the energy companies, we see this shift in capital spending as the companies try to slowly position themselves for a world where oil demand doesn't keep growing. And I think this year perhaps was a good reminder of how perhaps for many, demand growth in China was almost like a given. And then now we're looking at a potential paradigm shift in China where construction may not be as active as it used to be, which means oil demand may not just grow at the pace that we have gotten used to in the last decade or so. So yeah, very interesting report by OPEC, but the gist of it for me, as I looked at it, was that they still sound very, very optimistic for the long-term prospects of oil demand.
All right, thank you, Salih. Let's swing it back over to you, Joao. You've got a note looking at the valuation and outlook for European renewable players. So I wonder if you can give us a sense of what your note concluded and kind of how you generally are thinking about the prospect for renewable names, again, given that these kinds of companies are really in the news cycle here this week.
Yeah, sure. So we took a look at the European renewable developers, which is a group that includes Ørsted, EDPR, Acciona. Funny enough, it doesn't include RWE because, as Patricio said, they're not a pure player renewable. But this is a group that has faced, has clearly underperformed the market since 2021. Their combined market cap is about 50% below what it was at the start of 2021. And that is reflective of a volatile earnings pattern, growth challenges that they faced executing new projects, and an unfavorable interest rate environment until now over the last 2-3 years. Now, we think that in 2025, the fundamental outlook for these companies could inflect. We see the power price stabilization that Patricio mentioned since the lows of March as a tailwind, something that has been a headwind over the last 2 years, potentially turning a bit more favorable. The interest rate rate cutting path gaining visibility is also something that could support the outlook for these companies. And then, because they faced so many growth issues over the last few years, they've curbed their growth plans, and they now look a bit more risk balanced. And some of these utilities are already adding the run rate of annual additions that they want to be adding for the next 2-3 years, which provides better visibility on their plans. And so we think that these tailwinds might bring the attention back to their fundamentals. And for reference, consensus sees net profit rebounding 20% next year. That's after falling 15% this year and falling last year. So really growth could resume. And then the question is, are these companies able to deliver on their planned deployments? And that should ease concerns from investors in terms of their growth pattern and bring the attention back to fundamentals into this faster earnings growth profile.
Awesome. Okay, thank you. Salih, let's run back to you for one last topic. I think you noted to me over chat that Aramco has a new bond in the offing. And I'm curious because, again, I'm going to tie it back to the conversation of the moment. A lot of the debt holders, bond market folks do think about these long-term questions about oil demand, climate risk, risk from rise of EVs, et cetera. So I'm curious to get your sense whether any of that thinking is playing into the Aramco equation on the debt side.
Yeah, I mean, it is probably a better question for our colleague in the credit team, but it doesn't seem to be because you're right. I think with these bonds, I mean, they're looking at a 5 and 10 year shukuks in this case, but generally the demand for these bonds seem to be quite strong. And you could argue that because this is not just any other company, this is not just any other oil company. This is Aramco with obviously very strong government backing and pretty much a credit rating that's the same as the government itself. Because I think the way a lot of investors look at this company is that the same way they're looking at the country, and that's why generally the credit rating is very much aligned. But I mean, more so, I think what's interesting about this story of them taking on a little bit more debt and relevering is how they've essentially promised since the middle of last year to pay these special dividends, these performance-linked dividends that recently, in the last few quarters, given the drop in oil prices, the quarterly dividend outlay was actually higher than the free cash flow that they were generating. So they've been basically been in a position where their cash position has been dropping. They've started relevering as expected. They had a pretty strong balance sheet to begin with after the extraordinary year that oil companies had in 2022, given very high oil prices, extremely high natural gas prices, extremely high refining margins. So they were in a pretty good financial position, but mainly because, the majority of these dividends are going to the Saudi government or the PIF, the Public Investment Fund. So it was important for them to be giving these dividends, and they've continued to do so even as the macro environment and their cash generation has slowed. So it's not a surprise. Again, in terms of how much demand there will be, how well subscribed there will be, that's probably a better question for our credit analyst. But from what I saw, not only for Aramco, but also for ADNOC, for other oil companies in the region, issuing that recently, there seems to be quite good demand for these instruments.
All right, that's perfect. I think this is a good place for us to leave it for today, primarily because I have to go catch a flight. I know we normally run a little bit over, but I want to thank my colleagues, Salih, Patricio, and Joao for speaking. And for anyone who is in New York this week, you want to say hello, I'll be there this afternoon through Friday. So reach out, happy to grab a coffee or whatever. And from the chat, this is Jacksonville Airport. Lovely Jacksonville behind me. So until next week, I hope everyone has a great rest of their week, and we'll talk to you next Wednesday. Take care, everyone.